Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar, and with me on the pod today is Philip Webster. He is a director and portfolio manager for European Equities at BMO Global Asset Management. Phil looks after the BMO UK High Income Trust. Great to have you on the podcast, Phil. Nice to chat to you. Firstly, can you give us a sense of your focus in terms of what you're looking at day to day in the markets, what kind of time horizon you look at for your investments, and what's the sort of overall strategy?
Well, first of all, thanks very much for having me on. It's good to be here today and talking about the UK High Income Trust. I guess in terms of the last year, clearly we've been through a pretty unprecedented period of turmoil. So I think there's been phases of focus for me as a portfolio manager. I mean, wave one was most definitely about what I had in the portfolio, touching base with all of those companies, meeting management, IR, trying to get a sense of where businesses were. Companies were clearly, depending on where you are and what sectors you were in, some were impacted in a very minimal way. Tech clearly benefited from this quite quickly. And then you had travel and leisure at the other end of the spectrum where virtually everything stopped pretty quickly. So initially, we put a lot of energy and focus into those businesses and also trying to work out where balance sheets were. I mean, balance sheets were key in phase one, and we supported several capital raisings in that sort of early period at Compass and ASOS, businesses that we wanted to be in the right position to invest through this. But I think as we went in very quickly, we kind of came out quite quickly. I think management teams dealt with this very well and put portfolios in the right position. For me, the focus today is very much about who are the winners going to be. It's very difficult to predict earnings at the moment. We don't know when things are going to open. We don't know what that's going to look like. We don't know how the consumer is going to respond. But I think there's going to be winners and losers on the other side. And for me, the focus mainly is around business models, moats, who's going to take share and who's going to be bigger, better and stronger on the other side.
Yeah, so you've got quite a concentrated number of companies within your portfolio, about 35, I believe. How do you go about picking what goes in? You said this is a very difficult time. We haven't got much view in terms of earnings and guidance. What's been your real focus at the moment?
Yeah, it's a slightly unique product in terms of being as concentrated as we are. And I think from an income perspective, we don't own a number of additional sectors. So we don't have any of the high street banks. We don't own any oil and gas. We don't have any high street retail. We have very little in property. So the sort of high yielding sectors are not where we look. As I sort of said previously, it's not really a sector. It's very much stock specific. The way we think about this is a stock picking product. And at 35 names, you can set a pretty high bar for things you invest in. But as I said, I'm looking for who are the winners on the other side of this. So my focus is not, is it within travel and leisure? It's maybe a Wizz Air within that, a business that's up 56% over the last 12 months, despite carrying 80% less passengers. And you might ask why. Well, one, they had the right balance sheet going into this, so they've invested in the fleet. Airport fees are coming down, wage costs have come down, fuel costs have come down, and there's a huge amount of capacity coming out of the market. And these guys are still growing. So for me, the focus has been on those business models that are going to take share. And as I said, the winners on the other side. I think there's a lot of talk today about some of your tech business models that I own, some of the food delivery stocks and ASOS. To me, over the last 12 months, people have transitioned online. And when shops open or when people can go back to restaurants, yes, there will be a drop-off, but I think the structural shift has happened. And maybe this would have taken 4 or 5 years under an environment without COVID to happen, but the structural shift to digital was already happening before. This has just accelerated it. So for me, I focus on those sort of areas and trying to get a handle on businesses that I really feel are the winners and businesses where I think have an information on a structural advantage on the other side.
Yeah, it's really interesting to hear that you're sort of very interested in ASOS, but not investing in high street retailers. So is it specifically online retailers that you're now focusing on? And when we think about ASOS, what do you make of the deal with Topshop?
Online, I think, is key. I mean, the UK clearly has less of these types of business models, and maybe it's less tech and what we were doing traditionally anyway. I mean, food delivery was really, we used to pick up a phone and call our local takeaway, and now we're doing it through an app. I mean, time and other things have transitioned us away to, we probably cook less and do other things from that perspective. I mean, I think ASOS have done a very good deal. They pretty much bought 200 odd million of online only revenues. They've taken no stores with that, but the brands they bought did in store and online about 700 million worth of sales. So does some of that lost sales transition online? Potentially. But I also think you get the ASOS machine behind it. I don't think Topshop was the best operator. I think you get a much better service in terms of payment, in terms of delivery, in terms of through one app, that you don't need multiple apps. So I see the sort of network effects of that playing out. And I think you're seeing the high street do what you broadly expected it to do. I mean, there are businesses that are doing pretty well. I mean, your JD's and Next, although Next probably doing better because of its online business. But even the likes of Zara is closing, I think, over 1,000 stores. And it would probably be one of the bellwethers that you would say is a very strong operator on the high street, is now working out that the model has structurally changed. So I think companies and businesses are responding to that. My ethos is buy the structural winners, which is your ASOS every day. And I guess that's why we supported it at £15 when they raised capital, and it's £56, £57 today. So it's been an exceptional performer for us over the last 12 months.
So when we think about sort of the UK economic backdrop, obviously it's very hard to sort of guess what we're expecting in terms of the shape of the recovery, but obviously that influences your investment decisions. Do you have any kind of sense of how we might go back to normal out of these very unusual circumstances, and how that economic backdrop might influence some of the companies that you're investing in?
Yeah, I mean, I think that's the pretty big question that we're all trying to focus and analyse at the moment. I mean, the UK generally has been pretty unloved since the outset of Brexit, really, but I guess we've sort of put that to bed with very little noise. Or not completely put it to bed, but it's I think from an investment sentiment and perspective, it's definitely diminished as an impediment to investing in the UK. I think you've got very supportive central bank policy. You read the previous minutes, I think they were unanimous on keeping base rates low. They are unanimous on the continuation of the bond buyback programme and keeping liquidity in place. We've got a vaccination programme which is executing comfortably ahead of most of our European peers and ahead of the US. Now you can argue about the delivery of that, but generally we're going to exit quicker, and we have a roadmap. So I think you see in the last few weeks, travel and leisure stocks bouncing, consumer stocks in retail, hotel, the sort of open up trade. And I think that's what a lot of people are talking about today. And those are the sort of areas that you need to think about and focus on. Who are going to be the businesses that are going to benefit the most from this opening up? And I think you're starting to see that filter down. If you look at year-to-date performance, the FTSE 100's up about 4%, but then as you go down the market cap spectrum, mid caps up 5% and small caps up 11%. And small cap tends to be more domestic orientated business. So I think that trade is definitely gaining traction, that people are more comfortable that the UK is coming out of this, and they're likely to have more of their exposure to the UK domestic economy. And that's the way of having a look at this and potentially playing it. So yeah, I think the UK is actually coming out of this relatively well, and the roadmap looks quite clear. I'm sure there'll be hiccups along the way, and we've got 125 billion of extra savings that have been built up. So there's some pent-up demand there. There's cash in the system, but there are some unknowns and some fragilities around that we need to manage when we're thinking about the stocks.
Yeah, it's interesting what you say about sort of the large cap versus small cap performance in the UK, because, I mean, if we look at, say, the FTSE 100 more broadly versus the DAX hitting all-time highs this week, yet the FTSE isn't quite back up to those highs seen before the pandemic. Actually, it's still some way below. So its recovery from those March lows around this time last year has lagged behind some of the other indices around the world. Now, you say that the UK has been pretty unloved. Does that mean that this is a good time to get into the UK?
It's been very unloved. I guess it depends on the makeup of markets. I mean, it's not really a surprise why the US has done better, because it's tech heavy, and those have been the stocks that have performed the best over the last 12 months. And I think when you equalise some of the sector exposures, you'll still find the UK has underperformed. The UK is still cheaper. I mean, I guess when I look at the FTSE 100, the problem with it is it's so biased towards certain sectors. I mean, we know it's still heavily biased to oil and gas, despite the fact that those have been exceptionally weak. Glaxo's been exceptionally weak. One of the other big players, Unilever, since its unification, has not performed well at all and is now looking almost potentially cheap. Banks have performed badly. So your big sectors generally in the FTSE 100 haven't performed well. And those tend not to be the areas that I hunt in. I mean, the UK has so many great quality business in that mid-cap space, which is where I do a lot of my investing. Likewise, in small cap, we have great quality business models that really have sustainable competitive advantages. So whilst there's a lot of talk and discussion about Shell and a BP, those are not names I particularly want to own. I'd rather own other business models like Close Brothers or intermediate capital or something that is really high quality, that is unique. So for me, the fact that mid cap and small cap are moving at the moment is really testament to the fact that the UK has good businesses that are cheaper than other regions. And for me, I'm pretty bullish on the UK as a whole, especially down the market cap spectrum.
Phil, thank you so much for your time. It's been great to get your insights. So interesting to hear about some of those individual names like Wizz Air, Close Brothers, ASOS, and the opportunity overall in the UK.
Thank you very much.
And that was Philip Webster. He's a director and portfolio manager for European Equities at BMO Global Asset Management. I'm Victoria Scholar. Thank you so much for listening to our podcast, IG's Trading the Markets. And if you enjoyed it, please don't forget to subscribe.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.